Commercial real estate, or CRE, is now more screwed than it was in 2008. Nearly 12% of US office loans are dead, apartment loan defaults doubled in the last year, and $1 trillion of CRE needs refinancing by December at rates that make the maths impossible. Meanwhile, private equity has assembled a $400 billion war chest for what they're calling, quote, the greatest distressed cycle in 40 years. And somehow, none of this is front-page news. My name is Guy, and today we're going to talk about the $20 trillion crisis that's hiding in plain sight. First things first though, none of this is financial advice. I'm just here to explain how an entire asset class worth trillions is experiencing what the professionals call price discovery and what normal people call finding out. If you want actual financial advice, then pay someone with a license and a suit. I'm just a guy on the internet with a spreadsheet addiction and a concerning amount of Fed Minutes PDFs. And if you want more content like this, smash that like button, subscribe if you haven't, and ring that notification bell so you know exactly when the next financial crisis drops. So, commercial real estate. The ticker, the acronym, is CRE. It's basically the infrastructure of our hyper-financialized economic system. It's the office towers where people pretend to work. It's the shopping centres where people pretend to shop. It's the warehouses where Amazon stores your impulse purchases. And it's the apartment buildings where millennials pay 60% of their income to live in a shoebox. Now, in case that description didn't give it away, not all commercial real estate is created equal. Some sectors are getting absolutely destroyed, while others are having their moment. Understanding which is which can explain why the current crash isn't hitting everything equally. So, if it helps, you can think of CRE as the members of a dysfunctional family. You've got Office, the overachieving eldest child who just got fired and moved back home. He used to be the golden boy, but now nobody wants to talk about what happened. Retail, the middle child having an identity crisis. Half of them are thriving, half of them are dead, and nobody can tell which is which until the lease comes due. Industrial, the quiet youngest who is suddenly exceeding expectations. Everyone ignored warehouses until e-commerce and data centers made them the belle of the ball. And finally, multifamily, the steady cousin everyone's jealous of. As long as people need somewhere to live, apartments print money. Until they don't. Now, in case that didn't make it clear enough, when we talk about a CRE crisis, we're not talking about everything burning equally. Office is in the ICU, retail's in therapy, industrial's popping champagne, and multifamilies watching nervously from the sidelines. Keep this in mind, it matters for what comes next. This begs a bigger question though, and that's how big is America's CRE market? Well, try $20.7 trillion. To put things into perspective, that's more than 2/3 of the US Treasury market and of America's GDP. It's so much money that if you stacked it in $100 bills, I actually have no idea how high it would go because my calculator just shows error. But the thing is, unlike your house, which you'll probably keep living in even if it loses value, commercial real estate only works if someone's paying rent. No tenants, no income. No income, no value. It's like owning a money printer that only works if people show up to feed in the paper. And guess what? People stopped showing up. Now, commercial property value is simple maths. Annual income divided by cap rate, which is how much money a property earns each year compared to its price. When income falls and cap rates go up, which is exactly what's happening now, values collapse. And when the maths stops working, the defaults begin. Now, what turns CRE from a maths problem into a full-blown crisis is who owns these buildings, who lent the money, and who has the power now. Because in every financial crisis, knowing the players tells you who's getting rescued and who's getting sacrificed. It's like an even more dysfunctional family in our previous analogy, except this time it's reality. You've got property owners, the bag holders. From pension funds to real estate investment trusts to your uncle who bought a commercial unit thinking he'd become a property mogul. You've got the banks, particularly regional ones, who lent 80% against inflated valuations and called it conservative. You've got tenants, the ones with actual power now, who've started saying, "You want me to pay $80 per square foot to sit in a box? My team will work from home, thanks." And of course, there's the Federal Reserve, which spent a decade keeping rates at zero, then hiked them to 5.5% in 18 months, and is now acting surprised as everything breaks. But how exactly did we get here? Well, it all seems to have started after 2008, when commercial real estate was suddenly the safe play in the US as far as property investments went. Steady income, tax advantages, and with rates at zero, the leverage was basically free. Pension funds piled in. Insurance companies gorged themselves silly. Local banks made CRE loans like they were handing out sweets at Halloween. After all, everyone knows property values only go up, right? Well, that worked great until two things happened simultaneously. A pandemic made offices obsolete, and the Fed remembered that inflation exists. It's like getting laid off the same week your rent goes up 40%. Either one would hurt. Together, well, that's how people end up moving back in with their parents. Now, there's a saying that when you owe the bank $1 million, it's your problem. When you owe the bank $100 million on a building worth $60 million, that's the bank's problem. This saying is starting to be screamed from the rooftops by the suckers who aped into CRE. And this isn't some theoretical crisis brewing in America's future. It's happening right now. Office buildings in San Francisco have lost 70% of their value since 2019. We're watching a $20 trillion asset class discover that it's worth a whole lot less than everyone thought. But according to Jerome Powell, commercial real estate is just experiencing, quote, some stress. Some stress. Silicon Valley Bank also experienced some stress right before it collapsed in 2023, but the Fed doesn't like to talk about that because it was a failure of their oversight. And it's not like history ever repeats itself, right? But back to Jerome's comment, what does some stress actually look like? Well, according to Commercial Mortgage-Backed Securities, or CMBS tracker TREP, the delinquency rate for office loans hit 11.7% last month. That's worse than the 10.7% peak during the 2008 financial crisis. American CRE is literally in worse shape than during the meltdown that nearly destroyed the global banking system. For context, the same delinquency rate was 1.6% just 2 years ago. So there's a cool 7x for you. And that's assuming you believe the official data. If you do, well, I don't know what to tell you. I mean, it's fairly well known that the real scale of delinquencies on CMBSs in the US is being artificially suppressed by massive extend and pretend operations. When borrowers can't pay, lenders are giving them more time instead of admitting that the loan is dead. Don't believe me? Well, the New York Fed literally published a paper in October 2024 on how bad this extend and pretend game really is. They estimated that zombie loan preservation is reducing new CRE lending by around 5%, meaning banks are so busy keeping dead loans alive they can't make new ones. Tens of billions in CRE mortgages that should have been resolved keep getting pushed into future years rather than being dealt with today. But that's just office space, the overachieving child of the CRE family from earlier. Maybe we'll find a silver lining in multifamily. Remember, the stable cousin of the CRE family. Think again. Bloomberg reported that 46% of securitized multifamily loans maturing by the end of 2025 are insolvent. That's $47.3 billion in underwater apartment loans. Nearly half of all apartment complex debt coming due is mathematically impossible to refinance without massive losses. Carson Block, founder of investor research firm Muddy Waters, puts it bluntly, quote, "A lot of multi-unit residential in the US, particularly in the Sun Belt, is in trouble. And make no mistake, this wasn't the doing of professional investors. It was the doing of pandemic-era syndicates of amateurs who bought apartment blocks with floating rate debt thinking they'd discovered passive income. Now, with rates exploding and insurance costs in places like Florida up 11%, these landlords are discovering what floating rate really means. And it's not just offices and apartments. MSCI Real Capital Analytics reports total CRE distress hit $116 billion by March 2025, the highest in over a decade and up 23% year over year. The Federal Deposit Insurance Corporation notes that past due and non-accrual rates for CRE portfolios reached their highest since 2014. What's interesting, though, is that most of this toxic waste isn't held by banks. They only own about 29% of it. Office debt is mostly spread across bond funds, insurance companies, real estate investment trusts, and private equity through CMBSs and CLOs, or collateralized loan obligations. For multifamilies' $2.2 trillion in debt, over half is backed by government-backed mortgage giants Fannie Mae and Freddie Mac, meaning, yup, taxpayers are on the hook. So, now that we know who's holding the bag, let's open it up and see how big it is. As noted earlier, $1.5 trillion in US commercial real estate loans need to be repaid or refinanced by the end of 2025, according to Bloomberg. Now, the latest data shows it's closer to $1 trillion, but did $500 billion of debt magically disappear? Of course not. It got extended, modified, or already defaulted. The trillion that's left is just what they can't hide anymore. If you add in the 2026 maturities, then we're definitely back over $1.5 trillion in refinancing activity within a 2-year window. Some economists are calling this a, quote, maturity wave rather than a wall, as if that makes crashing into it any better. So let me walk you through the refinancing death spiral with some concrete numbers. You bought a building for $100 million in 2019 with an $80 million loan at 3.5% interest. Nice 80% loan-to-value ratio, very conservative. Fast forward to today, your building is worth $70 million and new loans are at 7.5% interest. The bank won't lend $80 million against a $70 million building. Best case, they'll give you 60% LTV, that's $42 million. So, you need to find $38 million in cash just to pay off your old loan. Oh, and your interest payments just doubled even on the smaller loan amount. And where does that $38 million come from? Nowhere. You'd better hand the keys back to the bank. This is exactly what's happening at the highest levels of Wall Street. Blackstone, the world's largest alternative asset manager with over $1 trillion under management, defaulted on a €531 million, that's $562 million, CMBS loan backed by Finnish offices and stores in March 2023. When Blackstone, with essentially infinite capital, chooses default over refinancing, what chance does anyone else have? And that was back in 2023, mind you. The concentration risk is unnerving to say the least. According to UBS data, small banks with under $20 billion in assets hold 56.1% of all commercial property loans. These are the same banks already stretched thin by deposit flight and rate pressure. To drive the point home, global real estate giant JLL estimates that 25% of the $1.5 trillion, so about $35 billion, will be, quote, hard to refinance, which is banker speak for these loans are dead, we just haven't admitted it yet. The funding gap between what's owed and what can be refinanced ranges from $200 to $400 billion. So, in sum, the maturity wall isn't coming, it's here, and there's no way over, under, or around it. So the good news is that major banks aren't holding most of this CRE debt, which means we won't get a 2008-style simultaneous collapse of the entire banking system. The bad news is that we'll just watch hundreds of regional US banks quietly disappear instead. And unlike 2008, when big banks got rescued, these small banks will vanish without a trace. Now, you might be wondering why you haven't been hearing about many American banks failing recently, especially given the circumstances around CRE and other unrealized losses. In short, it's because only 2 have failed so far this year. So, why is that? Well, it might be because regulators are letting them pretend that everything's just fine. According to Florida Atlantic University's banking initiative, 1,788 banks now exceed the regulatory danger zone of 300% CRE to equity ratio. Even worse, 216 banks exceed 600%. These banks are just zombies waiting for someone to pull the plug. Take Arkansas's Bank OZK. Almost 70% of its total loans, worth $17.4 billion, are in commercial property. Or how about New York Community Bank sitting at 57% exposure with $49 billion in CRE loans? The concentration gets worse the smaller you go. Data from Visible Alpha shows banks with under $10 billion in assets have 48% of their loans in CRE. Mid-sized banks with assets up to $100 billion aren't much better. These 4,000 plus small and regional banks are the backbone of American small business lending. When they fail, and many will, entire communities can lose their only source of credit. And the smart money is already making a run for it. Deutsche Pfandbriefbank, one of Germany's largest commercial property lenders, announced in June 2025 that it's completely exiting the US market. They're eating a €4.1 billion portfolio loss, just writing it off and walking away. CEO Kai Wolf called this, quote, the greatest real estate crisis since the financial crisis. When European banks are taking multi-billion-dollar losses just to escape the US, what chance do smaller local banks have? Heck, even the survivors are retreating. Bank OZK just capped all new loans at $500 million and is desperately trying to reduce its CRE concentration to 50%. CEO George Gleason admitted they're getting, quote, unwanted attention from regulators, which is a funny way of putting it, I must admit. So, foreign banks are fleeing, large regional banks are desperately diversifying, and small banks are trapped with no escape route. The pattern is pretty clear. This isn't going to be 2008's dramatic weekend collapse. It'll be a grinding process of hundreds of small banks quietly failing or being forced into distressed mergers over the next 3 years. And while those banks bleed out, the vultures are circling. Private equity's war chest has grown to $400 billion in dry powder, with 64% targeted specifically at North America. Record high doesn't quite capture it. It's more like ammunition for the biggest property grab in history. Brookfield just raised a record $16 billion distressed real estate fund, deploying $1.8 billion in Q1 2025 alone. And at the same time, they're defaulting on properties like Florida's $260 million Pembroke Lakes Mall. Now that is how you play both sides of a crisis. Buy distressed assets with one hand, default on your own underwater properties with the other. Meanwhile, KKR launched an $850 million opportunistic fund, and Cottonwood closed $1 billion for special situations, already generating 20% returns. And make no mistake, the suits are not here to save the market, they're here to perform financial necromancy on its corpse. The playbook is clinical in its exploitation. Wait for desperation to peak, buy at 30 cents on the dollar, evict existing tenants, and execute the conversion play. That dead office building becomes luxury micro-apartments. A failure can become a last-mile logistics hub. A branch of a failed bank can transform into an urgent care clinic, charging $400 to tell you it's just a cold. And the genius part is, they're using government programs designed to ease the crisis. PE firms are gaming Freddie Mac's workforce housing initiative, buying distressed apartments, cosmetically upgrading them, then jacking rents to the maximum workforce threshold. Meanwhile, office-to-residential conversion tax breaks meant to solve the urban housing crisis are being sucked up by PE shops, creating luxury units rather than affordable housing. So, where does this leave us? Well, to be blunt, we're watching a slow-motion hollowing out of American financial infrastructure while private equity builds a rental empire on its bones. Local banks with 40% of their loan books in CRE won't survive this. Your pension fund is probably sitting on hundreds of billions in exposure that hasn't been marked to market yet. And US taxpayers are on the hook for over half the multifamily debt through Fannie Mae and Freddie Mac. It's looking like a decade of credit contraction, zombie banks stumbling along, and private equity colonizing what remains. 5 firms will control more commercial real estate than the next 50 combined. They'll own the offices where you work, the apartments where you live, the warehouses that deliver your goods. The buildings will still stand, but they'll just have different owners, higher rents, and fewer exits. The wealth transfer mechanism disguised as a market correction is exactly what private equity does best. That's all from me for now, though. As always, thank you for watching, and I'll see you next time. This is Guy, over and out. Hey folks, before you go, I have a special announcement to make. If you enjoy the macro-focused content that we post here on Coin Bureau, then good news, you can now watch it on its own dedicated channel, Coin Bureau Finance. So, from now on, we'll be posting our non-crypto content on this new channel that's focused on all aspects of modern finance and investing, while keeping this channel dedicated entirely to crypto. And you can learn more about Coin Bureau Finance in this video here, and you can subscribe to the channel down here. Thanks in advance for your support.